There is a silent wealth machine that most investors walk right past. It requires no timing, no prediction, no genius, just patience and one simple rule. This is the story of the dividend snowball. What are dividends? Let's start at the beginning. A stock is a piece of ownership in a company. When that company earns a profit, it has choices about what to do with that money. It can reinvest into growth. It can buy back its own shares. Or it can share the profits directly with its owners. That direct payment, that slice of the profit handed to you simply because you hold the stock, is a dividend. Dividends have existed since the Dutch East India Company in 1602. The first publicly traded corporation in history used them to attract investors. The logic was simple. If you share the profit, people will trust you with their capital. Today, thousands of companies pay dividends. Some pay quarterly, 4 times a year, some pay monthly, and some, the very best, have been paying and increasing their dividends every single year for decades. Think about what that means. A company that paid a dividend 20 years ago and has raised it every single year since. That is not luck. That is a business built on durable, repeating profits. That is the kind of company that weathers recessions and comes back stronger. These are the companies serious investors seek. Because dividends are not just income, they are proof. They are quarterly confirmation that the business is working, the profits are real, and management trusts its own future enough to return cash to shareholders every single year. Now here is where the story gets interesting. Here is where the math does something extraordinary. Imagine you invest $10,000 in a dividend-paying stock. The company pays a dividend yield of 4%. So you receive $400 in dividends in year 1. That is nice, $400. But now imagine you take those $400 and use them to buy more shares of the same stock. You now own slightly more of the company. So next quarter, your dividends are slightly larger. You reinvest those, and then those dividends buy more shares, which generate more dividends, which buy more shares. This is called dividend reinvestment, and it is the engine that turns a modest investment into something remarkable. The math compounds quietly. In year 1, you earn $400. In year 10, if the dividend grows at just 6% annually, you are earning over $700 a year without adding a single additional dollar of your own money. By year 20, that number approaches $1,200 annually from the same initial investment. The snowball has been rolling down the hill the entire time, gathering size with each rotation. Now add in the share price appreciation. Great dividend companies do not just pay you, they grow in value. Your initial $10,000 might be worth $30,000 or $40,000 after 2 decades, while also paying you steadily increasing income the whole time. This is not speculation. This is not prediction. This is arithmetic. Powerful, patient, relentless arithmetic. There is a group of companies so elite that Wall Street gave them their own name, the dividend aristocrats. To earn that title, a company must be in the S&P 500 and must have increased its dividend every single year for at least 25 consecutive years. No interruptions, no freezes, no cuts. 25 years of rising dividends through recessions, pandemics, wars, financial crises, and technological disruption. Companies like Procter & Gamble, Johnson & Johnson, Coca-Cola. These are not flashy tech startups. They are businesses that make soap, bandages, and soft drinks. They make things people need every day, regardless of what the economy is doing. Procter & Gamble has paid a dividend every year since 1890, over 130 consecutive years. It has raised that dividend for 68 consecutive years. Think about what that means in practice. If your grandmother had bought shares in Procter & Gamble in 1956, those shares would now be generating a dividend yield based on her original purchase price of over 20% every year. Not 20% on today's stock price, 20% on what she paid, her cost basis. This is called yield on cost, and it is one of the most powerful concepts in long-term investing. The dividend does not just grow in dollar terms. It grows as a percentage of what you originally paid, year after year, for as long as you hold the stock. The aristocrats do not promise the fastest gains. They promise consistency. And in investing, consistency compounded over time beats almost everything else. So how do you actually build a dividend portfolio? What do you look for? There are 4 numbers every dividend investor watches. The first is dividend yield. This is the annual dividend divided by the stock's current price. A 4% yield means you receive $4 in dividends for every $100 invested. Higher is not always better. Extremely high yields can signal trouble. The second number is the payout ratio. This tells you what percentage of a company's earnings are being paid as dividends. A payout ratio of 40 to 60% is generally healthy. The company is rewarding shareholders but retaining enough to keep growing. A payout ratio above 90% can be a warning sign. The third number is dividend growth rate. How fast has the company been raising its dividend? A company growing its dividend at 10% annually is doubling its payment every 7 years. That growth is often more valuable than a high initial yield. And the fourth number, the most important, is consistency. How many consecutive years has this company raised its dividend? That track record is harder to fake than any quarterly earnings report. You do not need dozens of stocks to build a meaningful dividend portfolio. 10 to 15 well-chosen companies spread across different industries, consumer staples, healthcare, utilities, financials, can provide stable, growing income for decades. The goal is not to pick the next winner. The goal is to own a collection of businesses that will still be paying and raising dividends 20 years from now. That discipline, boring, methodical, patient, is what builds real wealth. No conversation about dividends would be complete without Warren Buffett. In 1988, Buffett's company, Berkshire Hathaway, began buying shares of Coca-Cola. Over the following years, Berkshire accumulated 400 million shares at an average cost of roughly $3.25 per share. Total investment, about $1.3 billion. Today, Coca-Cola pays an annual dividend of $1.94 per share. For Berkshire's 400 million shares, that is over $770 million in dividends every single year. That is more than half of what Buffett originally invested, received every year in cash from dividends alone, and Coca-Cola has raised its dividend every year for 62 consecutive years. Buffett did not time the market. He did not trade in and out. He bought a great business at a fair price, held it for decades, and let the dividends compound. This is the Buffett principle in its purest form. Find businesses that will be around in 20 years. Buy them at reasonable prices and have the patience to let time do the heavy lifting. The market rewards urgency with anxiety and patience with wealth. The dividend snowball rewards those who roll it and then step out of the way. The dividend snowball, it starts small, it moves slowly, but given time, it becomes unstoppable. If this lesson added value to your understanding of investing, subscribe to the channel. We publish in-depth stories about investing, stocks, and dividends every single week. Hit that subscribe button, and we will see you in the next one.